Okay, well, hello everybody. This is Dr. Salvatore Lanzafame, and we are here today to talk about the difference in doing journal entries from a stock issuance perspective and an owner investment perspective when we're dealing with corporations and non-corporations. So let's get started here. First off, let's do a quick little review for some of you that maybe it's been a while. But when we're looking at an owner investment in a non-corporation setting, we'll talk about a sole proprietorship. When the owners make an investment, the typical entry is typically, assuming that the owners invest cash, they would debit cash and then they would credit the owner's name followed by the word capital. So that's the typical journey. Let's say the owner invested $10,000. That's what the journal entry would look like for the initial investment. Looking at it from a corporation point of view, it's the same concept. Let's assume that the owners, who are now the stockholders, what they're going to do is they're also going to invest stock into the company, but in return, they now become the owners. So there's two ways to do stock issuances. One would be at par value, and the other one would be above par value. You can't really sell stock below par because in most states it's illegal. So it's either going to be at par or at above par. So the journal entry that would be made would look something like this. We would debit cash and we would debit, I'm going to be generic and just say capital stock, just so we can see the similarities between over on the left side with owner's name capital. But I just want you to know that instead of capital stock, we usually are a little bit more specific and we'll say something like common stock or preferred stock. So capital stock is generic for common or preferred. Okay, so capital, let's actually put capital stock in here. So capital stock is generic for common stock and or preferred stock. Okay, just so you've got some of that information. So let's create a little scenario here for the stock issuance at par. Let's say stock is issued, let's say we'll go 5,000 shares of stock is issued at $2 a share. Okay, we'll say $2 par value for $2 a share. So the stock is valued at $2 par and we're issuing it at $2 per share. So this stock is being issued at par. So if you just go 5,000 times 2, we're going to end up with $10,000 again. Okay, so that would be the first journal entry under a stock issuance situation. If the stock is sold above par, let me give you some more information as far as that goes. It would be something along the lines of 5,000 shares of, let's say, of $2 par stock is issued at $5 per share. So notice this time our stock that's valued at $2 a share, we're issuing it for $5 a share. Okay, so we're going to need an extra line here. So let's say the journal entry now is going to look like this. We're still going to debit cash, and this time we're going to have two credits. We're going to credit the stock account, and here's something that you need to remember, that capital stock or common stock or preferred stock, every time you credit it, it's always recorded at par. So 5,000 times 2, there's our 10,000. Okay. Now we're issuing it for $5 a share, so 5 times 5, that's going to be $25,000. So notice right off the bat that our debits don't equal our credits, so this is a problem. So whenever you issue stock above par, we need some help. And they created an account called paid in capital in excess of par. And basically you would put the difference between the cash of 25,000 and the par of 10,000. So we would go 25 minus the 10, and we have $15,000. That's what the journal entry would look like if we issued the stock above par. Okay. So notice in both cases, capital stock was credited and capital stock was recorded at par. So let's put that here. Whenever you credit the stock account, it must be recorded at the par value. Okay? So compare that to what we did, when you first learned accounting, probably chapters 1, 2, 3, and 4, where you weren't exposed to corporations. The journal entry was debit cash and credit your capital. But now we have a corporation setting, and the change is basically two different options. You're either going to debit cash and credit the stock account, both at par, or if the stock is issued above par, then you would actually have an extra account called paid in capital in excess of par. So basically, we are creating new equity accounts. All right, so let me just kind of go there for a second. So there's new equity accounts in this chapter, and we can say specifically these are new stockholders equity accounts. And these new accounts, all the ones I'm going to share with you here initially, will carry a credit balance. So we have capital stock. Let's go more specific. Let's go common stock. And common stock is going to have a new sidekick called paid in capital, which we'll just abbreviate as PIC, in excess of par. And we'll add a little caboose. We're also going to have preferred stock, and it too is going to have a PIC account associated with it. And if a company has both common and preferred stock, we need to make sure that we attach the caboose to that little title so that we don't use one PIC account for preferred when it was meant to be for common. So literally we have these 4 accounts that are in essence replacing what you used to know as capital. These accounts all carry a credit balance. So we'll just kind of make a quick little T account here just to remind you of how that's supposed to work. And let's just do this. Remember, since they are equity accounts, they work like liquor, if you remember that expression from a few videos ago. We have our debited accounts and we have our liquor accounts. These accounts are equity accounts, part of liquor, and they increase by a credit. Okay, so let me just write debit and credit above here as well, just so you remember that. I'm sure you do, though. So these are basically 4 new accounts that are involved. We also have another account that is not a stock account, but it's also part of liquor, and that's retained earnings. And retained earnings will also carry, a debit and a credit side, and it goes up by a credit and goes down by a debit. So retained earnings, I'll just copy this underneath it. But retained earnings is another account that is found in the stockholders' equity section. So basically, what's happened here is that what we used to use to kind of carry or wear a couple of different hats, capital, we now have different accounts to handle what capital used to do. So we used capital, if you think about it, we used capital for an investment situation, and we also used capital in an earning situation when we did closing entries. And we're going to review that shortly. So what capital used to do, we now basically have these 5 accounts in its place. Okay, so let's just make sure we see that. Number 1, number 2, number 3, number 4, and number 5. So 5 new accounts involved with basically, well, not, I wouldn't say involved. It would be like instead of what we used to use, which was good old capital. There are other accounts involved as well that you'll see in the next video, but just to kind of throw them out here, there's another account called dividend distributable. I don't want to get too much into it, but we'll go common stock dividend distributable. This too is a credit bearing account, so we'll put that there as well. So we'll count this as the 6th account. We won't see any activity in this video relating to that, but I just wanted to establish that with you. In addition to this, we have another account called dividends. So let's put this as a new account as well. And we'll call it dividends declared. You can have cash dividends and you can have stock dividends. But the dividend account is actually going to go up by a debit instead of a credit. So let's just put that in there. And then finally, the last account that I want to put up here is an account that is our only contra equity. So we'll make this number 8. And let's just say it's a contra equity. So if it's a contra equity, it kind of works like dividend does. And the contra equity account is called treasury stock. And treasury stock will make your stockholders' equity section go down. Okay. And then last but not least, let me give you one more. And we'll call this a 9th new account that's in the mix between this chapter and the next chapter. And this is a sidekick to treasury stock, and it's a pick account again. Pick from treasury stock. And the pick from treasury stock is a normal equity balance carrying a credit balance. Okay, so these first 4 carry a credit balance. So does the 5th one, retained earnings. So does the 6th one, common stock dividend distributable. And so does the 9th one, which is the pick from treasury stock. But dividends declared and treasury stock, they carry debit balances. So those are all the new accounts. Now with the first 4, I just made one T account, but it would be one for each. Okay, and then I kind of separated the other ones out. But I just wanted to give you a little bit of a heads up of some of the new accounts that you're going to be, experiencing in the next 2 chapters here. Okay? All right, so now let's go and look at a comparison of how closing entries are done. And you might see two of the accounts that I listed here in the new 9. You might see two of the accounts involved. All right, so let's go ahead. I'm going to move the screen down a little bit. And we're now going to do a closing entry comparison. All right. And again, it's going to be corporation versus non-corporation. And we'll do the non-corporation on the left, and we'll do the corporation on the right. And again, the focus of the non-corporation would be a sole proprietorship. So we're going to do a closing entry comparison. So a little bit of a review on the left side, and on the right side, kind of review, but some new accounts involved, but the process will remain the same. So remember the point of closing entries. If you remember, in a non-corporation, we had 3 goals. Goal number 1 was to update capital. Goal number 2 was to get the net income amount, or net loss, to appear in the books. And remember, the books are the general journal and the general ledger. That's what we mean by the books. And goal number 3 was to close the temporary accounts, which I affectionately referred to as the red accounts. If you remember, the R was for revenue, the E is for expenses, and the D was for drawing. So I referred to the temporary accounts as the red accounts. Okay. In a corporation, the goals are still very similar. And basically, goal number 2 and goal number 3, very, very close. But goal number 1, we don't really have the capital account. Remember, capital wore 2 different hats. In a non-corporation, it handled the investment section, and then it also handled the earnings section. Now what we're doing in a corporation, we're saying, hey, capital, slow your flow, right? You're doing too much work. We're now going to have separate accounts to do all the different things you used to do. So when it comes to investment, instead of using capital, we're now going to use common stock or preferred stock or generic capital stock. When it comes to earnings, instead of closing income summary into capital, we're now going to close, instead of capital, we're going to close stuff into retained earnings. So retained earnings is basically going to take over the job of capital in the closing entry process. So having said that, the goal, number 1 goal of closing entries now is to update retained earnings. Goal number 2 is the same, to get the net income amount or net loss to appear in the books. And again, general journal and general ledger. And goal number 3, to close the temporary accounts. The nice thing about my acronym RED, or my mnemonic device RED, is that we can still use it, except now the R still stands for revenue, the E still stands for expenses, but now the D stands for dividends. So we can still get away with using that little word red. Okay? So you've heard me talk about debit accounts, assets, drawing, and expenses. Well, now we can still use debit aid. It's assets, dividends, and expenses. We still have our liquor accounts, liabilities, capital, and revenue, but now it's liabilities, capital stock, revenue, and retained earnings. So liquor now sounds like you're kind of drunk, liquor. So we gotta kind of stress the R's in there because we got a couple of R's to deal with. But let's focus on the closing entries now between the two different situations. Now that we've established the goals, let's go ahead and do this. So the first closing entry is to close our revenue account into income summary. The first two closing entries are actually identical under the two systems. So we're going to, remember, revenue carries a credit balance. It's a liquor account. So in order to close it, we've got to debit it. So let's just go with, service revenue or sales. Remember, we either called it service revenue or sales. So let's go with both. I'll put them both in here, so we can cover all the chapters that we've dealt with our revenue accounts. And we're going to close it into income summary. Okay, so pretend we had $5,000 worth of service revenue, we had $10,000 worth of sales, and we're going to credit income summary for the total of those two, which is $15,000. Then the second closing entry is we want to close our expenses into income summary. Okay, and to do that, remember, expenses are part of debit aid and they have debit balances. So to close them, we have to credit them, which means we've got a debit income summary first because we always have to write our debits first. We don't really know this number until we add up all our credits. So let's say we've got rent expense for $700. Let's say we've got salary expense for $2,500, and let's say we also have advertising expense. I'm sure we would have a lot more than this, but let's say that's $300. Let me just fix this. Put that $2,500 here. So what we would do then is we would add up all of those credits and we would put the total as our debit to income summary. Okay, hopefully that rings a bell. So I'm going to just copy and paste this over to this side because you would never know looking at the first two closing entries whether we are dealing with a corporation or a non-corporation. So the closing entries of revenue and expenses, no change. What's different is what happens in closing entry number 3. Under a non-corporation, we're going to close our income summary into capital. So income summary, we need to know what our balance is. So if we had $15,000 on the credit side and $3,500 on the debit side, that means we have $11,500 as our balance in income summary. So, and that's a credit balance, right? Because our credit is bigger than our debit. So because our credit is bigger than our debit, income summary carries a credit balance. So to close it, I got to debit it. Okay. So I'm going to take 15,000 and I'm going to subtract out the 3,500. There's that 11,500. And if I'm if I'm debiting something for 11,500, I have to credit something for 11,500. And that account was the owner's capital. So remember, you're trying to close income summary, and the amount gets closed into capital. And then finally, closing entry number 4, you may or may not need to close out this one, because if the owner didn't make a withdrawal, then there's no drawing account to close. But let's pretend they did have it. So we're going to close our drawing account, and we're going to close it into capital. Since drawing is part of debit aid, and drawing carries a debit balance, to close it, we got to credit it. So I'm going to skip the debit for a second, go right to the credit section, and let's pretend we had $500 worth of drawing. Drawing is the same thing as withdrawals. So if I'm crediting something for $500, that means I've got to debit something for $500. And what are we closing drawing into? We're closing it into our capital account. So those were the closing entries that we used in a non-corporation setting. In a corporation setting, again, notice the first two closing entries are identical, but the difference is we're now going to close our income summary. We're going to close it into retained earnings. Remember earlier I said retained earnings is going to take over for the job capital used to do in a non-corporation setting. So we're going to debit income summary for that 11.5. And if I'm debiting something for 11.5, I've got to credit something for 11.5. And that something is now retained earnings. So retained earnings is taking over the job that capital used to do. Okay, so if you can just remember that, you've got this basically licked, because the first two closing entries, there's no change at all. And then finally, instead of having drawing, we now have dividends. So dividends is replacing drawing in a corporation setting, and retained earnings is replacing capital in a corporation setting when doing closing entries. So we're going to close the dividends into retained earnings. So we are going to, let me skip the debit spot again, just like I did before, and we're going to credit the dividends. We can call them dividends or dividends declared, same idea. And we're going to pretend that that's 500 as well. And if you credit something for 500, you've got to debit something for 500, and that something is now retained earnings. Okay, and those are the closing entries. So you're seeing the closing entries under a non-corporation, and now over on the right side, you're seeing the closing entries in a corporation. Okay, so hopefully what I did makes a little sense to you. If it doesn't, please make sure you read your chapter on corporations. You know, depending on what book you might have, it might be chapter 13, it might be a different chapter, but you know, every principles book typically has a chapter or two chapters on corporations. So the first thing you want to recognize is that we've got a whole bunch of new accounts involved. And if I can just go back and just review with you, we now have common stock. It has a sidekick called PIK in excess of par common stock. We have a preferred stock account, and it has a sidekick called PIK in excess of par. All four of these carry a credit balance. We have a new account called retained earnings. It carries a credit balance. Those are the ones that you probably will see a little bit of in this chapter and also the next chapter, or if your book has just one chapter dedicated to corporations, you'll see it in that chapter. We also have another one that's called common stock dividends distributable. We could have preferred stock dividend distributable, but I'll just focus on common stock in the upcoming videos. There's an account called dividends declared. Dividends is replacing what we used to know as drawing. And then we have this contra equity. So remember we had equipment, and equipment had a contra associated with it. It was called accumulated depreciation. In another video, you saw where we had accounts receivable, and it had a contra called allowance for doubtful accounts. Remember, contras do the opposite of the category. So if we're talking about a liquor account goes up by a credit. Common stock, PIK, preferred stock, its PIK, retained earnings, common stock dividends distributable, they all carry credit balances. But treasury stock is a contra equity. So it's going to make the stockholders' equity section go down, whereas all the other ones I just mentioned are going to make your equity section go up. So notice it has a debit balance, and it's going to work against or the opposite or contra to the regular accounts in that category. But this funny contra equity account has a sidekick, but the sidekick works opposite of the main account. So notice that little difference there. Whereas these sidekicks work the same as their parent account. Okay, and then remember the first thing we did was we compared the difference between investments in a non-corporation and in a corporation. In a non-corporation, when the owner makes an investment, we debit cash, we credit capital. That's assuming they're investing cash. And then under a corporation, there's two ways to do it. If you issue stock at par, and by the way, par is just an arbitrary value that a company's board of directors establishes at the point that they go public, or maybe right before they go public, and they make it extremely small. Like $2 is kind of high. It might be $1, might be 10 cents, might be a quarter. They purposely make it small so that you can't sell the stock below that value. As I said before, in most states it's illegal to sell stock or issue stock below the par value. So they make it small to avoid that potential controversy. But if they do issue stock at par, notice we debit cash and we credit capital stock. Or we could have credited common stock to be more specific, or credited preferred stock to be more specific. Remember, your stock account is always recorded at par. So whether you're doing the one that's in purple or the one in blue, your stock account is always at par. So if you sell stock above par, like you see in the blue, then you still would credit that stock at par. You debit cash for the total amount, and now you involve a sidekick account called PIK in excess of par. And I basically abbreviated the words paid in capital to PIK. So we would need a PIK account every time you go above the par value. And just a little FYI, this is fairly accurate. It might be off by a few percentages, but typically only 25% of publicly traded corporation stock, all right, so basically only 25% of companies out there, I should say, have preferred stock. So most companies that are corporations do not even have preferred stock. So 3 out of 4 companies don't have preferred stock. But if they do, something that we'll talk about in the next video or so, preferred stock gets first crack at dividends. And then whatever's left goes to common. So just throwing something out that we'll see down the road. Okay, well, I hope these examples helped. I'll be doing another video. In fact, I probably have about 3 more videos coming on corporation transactions. All right, well, you guys have a great day. I hope this was very helpful. Again, this is Dr. Sam Lanzafame, and looking forward to working with you again. Take it easy. Bye-bye.